we have officially entered the realm of the impossible. The very first weeks of 2026 have seen silver rocket to unprecedented heights and trigger shocks in the global financial system. In days, spot silver has exploded from the low 70s to well above 90 per ounce, a parabolic surge that defies every past model. Analysts around the world are on alert, warning this is no normal market cycle. The silver market is in full crisis mode, and the story is only just beginning. It all started when gold and silver embarked on a historic rally late in 2025. By January 1st, prices had already spiraled. Spot silver sat around $72 an ounce, up hundreds of percent for the year, and millions of investors could sense something was brewing. Then on January 13th and 14, silver literally tore through records. It hit an all-time high near 89 TARs, then broke $90 per ounce. Investors were stunned. Some had lived through bubbles, but this was beyond anything seen before. The trigger? A tsunami of factors. In the US, softer inflation data and geopolitical uncertainty sent Fed rate cut hopes to the roof. Wall Street money, drained by crypto and meme mania, poured into hard assets. Retail traders piled into silver ETFs in near panic. One report put recent inflows at nearly $1 billion in just weeks. By January 15th, analysts noted nearly $92 an ounce price levels. Goldman and JP Morgan were publicly forecasting a drop, but for now, the rallies kept coming. A bullish frenzy had taken hold. 0.24. Narrator. But within that rally, warning lights blinked. Every rally needs fuel, and where would so much metal come from? Inventories were already dwindling. COMEX registered silver stocks had been cut by about 70% since 2020, according to market data. London vaults were near record lows. A vicious structural deficit, now 5 years running, was burning through every ounce on hand. In mid-January, none of this was common knowledge in the mainstream, but the signs were undeniable for those watching. Physical demand was gobbling supply. Asian industries and investors were stockpiling silver at any price. In China, the world's biggest refiner and exporter of silver, a strategic decision took effect on January 1st. The government listed just 44 companies allowed to export silver in 2026-27, effectively cutting global supply. Huge premiums emerged. Shanghai dealers were paying $6, $9 above American prices for bars. In India and Japan, buyers lined up to pay nearly double the official price for spot metal. Silver simply vanished from retailer shelves. That Asian squeeze sent shockwaves west. In the United States, Wall Street bank desks went from ecstatic to panic in hours. A critical alert went out in hushed tones. Large bullion banks had placed gargantuan short bets on silver during 2024 and 2025. Now, with prices tripling since last year, those shorts were bleeding money faster than any trader knew. All impossible math is how some describe it. Spreadsheets with numbers no sane human could read without fainting. Those banks faced same-day margin calls that could run into the billions. On Main Street, bloggers and YouTube pundits began whispering of an unfolding short squeeze. One viral forum post claimed that JP Morgan Chase was carrying a silver short well over 6,000 tons, a position so large that covering it could bankrupt the bank in a flash. It's all unconfirmed, but desperate enough to fuel panic. Silent behind this speculation is the New York Fed. Regulators recently lifted caps on emergency lending and quietly injected tens of billions into Wall Street coffers, allegedly to keep liquidity flowing. One rumor, unverified but persistent, spoke of a $17 billion late December repo bailout tied to these precious metal losses. Meanwhile, the CME group, which runs the COMEX where silver contracts trade, took action. In mid-December 2025 and early January 2026, the exchange tripled performance bond requirements for silver futures. On January 7th, CME's rule shapers quietly hiked margin requirements nearly 50%, demanding every trader post vastly more cash per ounce. In layman's terms, if you thought you could gamble on silver, you had to ante up with far more dough overnight. The price of being wrong just doubled. The artificial throttle was in place. The squeeze was global. In Europe, commodity houses felt the pain. London bullion vaults reported minuscule remaining silver, and whispers said Swiss banks, known to be heavy silver holders, were scrambling to secure deliverable ounces. Germany, Italy, and France have major silver-consuming industries, from solar panel plants to EV factories, now jittering over supply. Here in the old world, massive banks have also speculated in precious metals. Even if they haven't gone public, they're pulling late-night meeting marathons, calculating their net exposure. At the very least, they began quietly stockpiling any physical silver they could. Down under Australia, a top 10 silver miner, ramped mines into high gear. Suddenly, every ounce counts. Australian producers announced January output was up modestly, but industry experts warned that even double production would barely make a dent in global demand. The silver deposits are mostly byproduct of gold, copper, and zinc mining, so silver output doesn't rise easily just because prices soar. Engineers note that mine grades are falling, projects take years to build, and nearly all Australian silver fields are fully staffed. The message from Perth to Melbourne: we're working, but the supply chain is threaded on a knife's edge. 120. Narrator: in fact, 2025 ended with a shortfall of roughly 95 million ounces, by some estimates. That is roughly 30% of annual production. No simple switch can plug that gap overnight. Many miners said they would try to accelerate projects in 2026, but analysts are skeptical. Even if Australia or Latin America cranks output higher, it will lag far behind booming demand, from renewable tech, from electronics, from hedge portfolios, and from governments treating silver like strategic oil. Governments indeed have reacted. The U.S. had already designated silver a critical mineral, triggering mandates to build strategic stockpiles. Now regulators in Washington are quietly discussing what happens if the price goes parabolic. Would they require banks to post collateral? Might Congress demand transparency on these opaque trading desks? Meanwhile, the Chinese state is blissfully hoarding in private, focusing on domestic needs. One leaked tweet, allegedly from a senior Chinese official, expressed outrage at export curbs. But Beijing's policy is clear: secure all you can at home. India's response has been dramatic. On January 10th, reports emerged from Raikot, India's silvercraft hub, that 44 trading firms had defaulted and declared insolvency as prices surged. They lost an estimated Rs 3,500 crore, about 425 million. Those firms were the ultimate paper players, betting on futures that never delivered. When prices jumped 30% in a single month, they simply couldn't pay. Jewelers stopped manufacturing. Bankers in Mumbai quietly took note. If a local Indian market can implode under silver's weight, a global blowout is not impossible. On the institutional side, fund managers are scrambling. U.S. ETF flows show silver becoming the most crowded trade on record. Even aggressive banks like Goldman and Morgan Stanley are telling clients to trim longs. They smell a bubble but are stuck with clients clamoring for more. Hedge funds see the volatility, and many have unwound shorts, fearing counterparty risk. A few players playing the short side have already blown up. Meanwhile, central banks, not known to hold much silver, are noticing. Whispers of covert buying by Russia and others circulate, fueling paranoia that governments may soon join the hoarders. Investment banks themselves are in a quandary. 3 months ago, they thought silver peaked. Now they're warning $100 is possible and $150 within reach. But behind the bullish talk lies dread. Covering losses could wreck balance sheets. All it takes is one protracted spike or a sharp crash to blow them sky high. Banks have always danced with metals markets, but not at this voltage. One former executive likened the situation to playing Russian roulette with a fully loaded cylinder. Then there are the leaks. Somewhere on social media, anonymous screenshots appear showing exchange ledgers and delivery reports. One purported COMEX report, fully unverified, shows registered silver supply plummeting by 26% in a week, leaving barely 28 million ounces for delivery against hundreds of millions of paper claims. A conspiracy-minded tweet claims trading desks have off-balance sheet contracts totaling billions of ounces, more than exist in any vault. We can't confirm these, but their viral spread has market players uneasy. When traders see market data, not blog posts, moving sharply, it's trouble. Meanwhile, Western commodity exchanges quietly warn of a crunch. Commitments of traders show historically lopsided books. Long positions outnumber shorts many times over. Few are willing to stand against the tide. The CME's late 2025 moves were a hint. In December, the Fed opened a dedicated repo facility, and the CME raised margins unannounced, all signals that regulators see unprecedented strains in silver and gold markets. It's a hidden alarm bell ringing in the dead of winter. Across continents, the scramble is on. In New York, dealers in Silver Eagles are sold out. In Shanghai, traders text frantic queries if any bars are left. In London, a rare shipment of kilo bars sold within minutes at a huge premium. In Delhi and Mumbai, jewelers and investors are hoarding every gram they can find. Energy executives eye silver as a bet against inflation. The global hunt for physical silver has gone into overdrive, and many fear that if demand spikes just a little more, the market could literally run dry. Experts say this confluence is historically rare. A precious metal rarely sees this kind of bifurcation, paper prices racing upward and physical shortages as real as any commodity crisis. It's impossible math, because the official price, a $90 RAWs, no longer matches reality. In real terms, a silver bar in Asia is trading at 1.5 times that. The divergence itself is unprecedented, as if oil sold by the barrel was far cheaper in futures markets than on the dock. Some courageous analysts have tried to calculate the true shortage. One broker estimated that global inventories, mines plus above ground, can't cover even a few weeks of current demand. The physical market is so constrained that barter-type trades are happening. Reports of solar manufacturers offering premium to finish contracts, jewelry workshops waiting weeks for mill deliveries. It's a fever pitch, and yet official channels remain largely silent. No world leader has publicly addressed it. No central bank spokesperson warned of a silver squeeze. On the contrary, headlines still talk about rally, record highs, or profit-taking. For example, Reuters noted a pullback in spot silver near January's end as traders took gains, but down only 5% from highs. For most media, this is another commodity bubble. To us, it's a crisis unfolding beneath the surface. Institutions from small mining funds to sovereign wealth vehicles are advising clients to be cautious. Some funds have placed stop-loss hedges on their silver positions. Others have taken emergency profit locks above 90. But all of them know one thing. The future is wildly uncertain. If silver continues higher, there may be no limit to losses. If it collapses, anyone now holding big paper positions may find they can't deliver the metal. Back to politics. The Trump administration publicly pushed for lower interest rates into 2026, which buoyed precious metals. Now internal briefings are apparently questioning the decision's fallout. If monetary policy really loosens as many expect, traditional safe havens could stay in favor. Silver, after outperforming gold in 2025 by a mile, is now squarely under the microscope. Geopolitics adds another layer. Reports of alliances forming around non-dollar resource trades are doing the rounds. Some nations may be eyeing silver reserves as a backup if other markets quake. You might not hear it on the evening news, but in the halls of power, everyone is asking, who holds the silver now? Could this be weaponized? Because if one country needed a lifeline, silver could oddly become as strategic as oil. At home, Americans everywhere are discussing the silver story online. Memes of buyers with silver rifles circulate next to charts of soaring prices. One post joked about JP Morgan being the last man standing with all the silver. It's feverish and ominous. Retail interest is hitting levels not seen since 2011, but most retail investors have no idea how fragile the system has become. They just know every day they wait. Silver seems more expensive. The crisis of faith in paper markets also has echoes in crypto and tech stock circles. As Bitcoin and AI stocks corrected, talk of a hard asset pivot became mainstream. Advisors now openly say, diversify into silver in chats. Meanwhile, legacy pension funds are quietly topping up gold and silver positions, fearing the next crash will hit debt-laden equities hardest. Asia's industrial engine, already hungry for chips and minerals, is facing a silver shortage too. India consumes a large share for jewelry and electronics. Prime Minister Modi quietly chaired a meeting on precious metal imports this week, concerned about remittance hits from soaring silver prices. Japan's solar industry is stockpiling. Korea's auto parts suppliers are renegotiating contracts. If factories slow due to silver scarcity, it could ripple through global supply chains faster than anyone predicts. In Australia, the government is calling an industry summit. Through all this, one thing is clear. If silver keeps moving at this pace, something has to give. A crash could trigger a cascade of margin calls and defaults reminiscent of 2008, the financial historians warn. Or silver could stay high and bankrupt shorts until only physical holders remain. Either way, the stage is set for a showdown. And now we turn to you, the viewers. This is not a drill. We are living through a monumental market event. The data, the signs, the rumors, they all point to one thing. A breaking point is imminent. We documented how prices and policies have played out over these first 3 weeks of January 2026. The US, China, Australia, and Europe are all enmeshed in this crisis in different ways. The silver market is like an overloaded ship. Will it stay afloat or capsize under its own weight? We don't know yet. But if you hold silver or stocks in silver miners, pay attention. If you're a trader, buckle up. We've entered this new era of volatility. What comes next could reshape the financial landscape. This is an emergency report. We are chasing every development, every rumor, every leak as it happens. The silver story has gone from dormant to critical alert in a matter of days. In the hours and weeks ahead, watch for documents or reports leaking out of banks, central banks, or exchanges. These will offer clues about who's winning or losing. 424. Narrator. For now, keep your eyes on price charts. At this moment, silver is above $90 a troy ounce and climbing. Keep your eyes on premiums. Shanghai is still trading richer than New York. Keep your eyes on inventory reports. Some sources say COMEX warehouses have only a few weeks of metal left. Every price tick is a heartbeat. Every report is a warning. 432. Narrator. We'll continue to follow every twist in this saga. Because one thing is certain. When the dust settles, the fallout from this silver crisis will be felt far beyond the mining pits. It could rattle banks, economies, even governments. Welcome to the silver frontier of 2026. Fasten your seatbelts. In a world running on paper promises, silver might just prove to be the wild card that turns the tables. Stay tuned. The outcome of this unfolding crisis will determine the fate of fortunes, industries, and perhaps entire nations.